America's 50-year mortgage isn't just a policy idea, it's the biggest warning sign in the history of U.S. housing. When a nation reaches the point where families need half a century to buy a basic home, it means something fundamental has broken. Home prices are up over 118%, wages barely moved, mortgage rates hit 7%, and the dream of ownership has collapsed. A 50-year loan doesn't solve this crisis, it simply stretches the debt across your entire adult life. What looks like affordability is actually a financial trap designed to keep Americans paying forever. America's 50-year mortgage proposal didn't appear out of thin air. It's the final evolution of a system built over decades to convert shelter into a long-term financial instrument. To understand why extending loans to half a century is even being considered, you have to see how the original structure of mortgages was engineered. It was never just about homeownership. It was always about liquidity, profit, and preserving a debt-driven housing economy. Mortgage design changed permanently when the U.S. government standardized lending in the 1930s. FHA guidelines, Fannie Mae, and later Freddie Mac created the modern 30-year amortized loan, not because it was the perfect consumer product, but because it created predictable payment streams banks could package and sell. By the 1970s, mortgage-backed securities turned American homes into $12 trillion worth of bond-ready assets. Banks weren't lending for houses, they were manufacturing long-term cash flows. This is the foundation for today's shift. Once housing became securitized, the priority moved from helping people own homes to ensuring investors had a stable supply of debt to buy. Extending mortgages from 30 to 50 years fits perfectly into this framework. Longer loans mean more interest income, more securities to package, and more time for the system to extract value. A single $450,000 mortgage at 6 to 7% becomes a multi-decade revenue stream worth over $1 million in payments, and lenders know it. The design also ensures that affordability optics replace real affordability. Lower monthly payments make homes appear accessible, even while prices rise far beyond income growth. The structure benefits institutions by keeping demand elevated, protecting property valuations, and ensuring the mortgage market continues to function even when incomes stagnate. This is why housing policy always leans toward expanding credit rather than addressing supply constraints. The 50-year mortgage is not an innovation. It is the logical extension of turning homes into financial products whose primary purpose is to generate return, not provide stability. And once this perspective becomes clear, the push for longer mortgages becomes less about helping buyers and more about sustaining a system that requires perpetual debt to survive. The timing of the 50-year mortgage proposal is not accidental. It is emerging at the exact moment when the U.S. housing system is under maximum stress. Mortgage rates surged from 3% to above 7%. The median home price climbed to over $415,000, and the income-to-home price ratio hit its worst point in modern history. With affordability collapsing, sales falling, and national inventory at record lows, policymakers are facing a political and economic crisis. Extending mortgage terms is being positioned as a quick fix, not because it solves anything, but because it temporarily masks the damage. Federal regulators and political leaders have strong incentives to create the illusion of relief. High housing costs are now a top voter concern, and lower monthly payments appear to be a solution on paper. A 50-year loan cuts the monthly burden just enough to make headlines, even though the reduction is often less than $100. That number is politically convenient, not economically meaningful. It creates the appearance of action without addressing the structural failure in affordability. Behind the scenes, powerful financial and corporate interests also benefit from this timing. Builders need demand to stay high, as construction costs rose more than 32% since 2020. Banks want longer, more profitable payment streams, as refinancing activity collapsed 88% from its peak. And Wall Street firms require steady mortgage volume to sustain a multi-trillion-dollar bond market built on long-term debt. A 50-year loan does exactly that. It extends profitability without expanding supply. The pressure is amplified by slowing home sales, shrinking tax revenue from real estate transactions, and declining economic output tied to housing-related industries. Politicians know that collapsing housing activity can drag down GDP, consumer spending, and employment. Extending mortgages artificially boosts eligibility, lifts demand, and protects housing values from falling too quickly. It is a defensive maneuver disguised as an affordability measure. What looks like a policy solution is actually a strategic response to a system approaching breaking point. The 50-year mortgage is being introduced now because it buys time, stabilizes financial markets, and shields institutions from price declines, all while shifting the long-term cost onto the buyer. The pitch behind a 50-year mortgage sounds simple: smaller monthly payments. But when you break down the numbers, the illusion becomes impossible to ignore. A slightly reduced payment hides a catastrophic increase in total cost, total interest, and total financial dependence. The mathematics is not complicated. It's just rarely shown to the public. Take a $500,000 home with a $450,000 mortgage. At 6% on a 30-year loan, the monthly payment sits near $2,698. Stretching the term to 50 years brings that number to roughly $2,619, a difference of only $79. But that $79 relief requires 20 extra years of payments, the equivalent of paying for an additional entire home. And this is where the system quietly extracts its profit. The 30-year loan results in approximately $517,280 in total interest. The 50-year version surpasses $1,110,000. That's $596,000 more, not for a bigger home, not for better terms, but simply for longer participation in the debt cycle. The mathematics becomes even more alarming when examining amortization. The early decades of a 50-year loan are almost entirely interest. The borrower barely reduces the principal, meaning the loan behaves like a long-term rental contract disguised as ownership. The lender, however, receives secure, predictable cash flows for half a century, exactly what financial markets want. This design has a direct consequence. The borrower remains locked into payments until age 75 or later. With wages rising only 17% in 20 years, while home prices climbed over 118%, the system relies on stretching loans to maintain the illusion of affordability. The numbers prove the trade-off is not a discount, it is a multiplication of cost. And that multiplication is absorbed entirely by the buyer. This mathematical structure connects directly to why the product exists at all. Extending mortgages doesn't reduce prices, doesn't improve access, and doesn't fix supply. It simply extends the life of a payment stream. The math exposes a truth the public rarely hears. The 50-year loan is engineered to preserve the system, not the consumer's finances. The financial burden exposed by the math leads directly to a more damaging consequence: the destruction of equity. Home ownership has historically been the backbone of American wealth because equity builds steadily over time. A 50-year mortgage rewires that process completely. Instead of accelerating ownership, it slows wealth creation to a crawl, keeping borrowers locked in a financial holding pattern while lenders collect decades of interest. With a traditional 30-year loan, a homeowner typically gains meaningful equity by year 10 and pays off the property around age 55 to 60. That timeline creates a 20-year window where the owner is mortgage-free, allowing wealth to grow through saved payments, investments, or retirement planning. This is how middle-class families historically built net worth. But stretching the loan to 50 years erases that window entirely. The borrower reaches age 75 to 80 before the home is paid off, leaving virtually no debt-free years to compound savings. The erosion becomes clearer when examining principal reduction. On a $450,000 mortgage, a 30-year borrower could owe less than half the balance after 15 years. A 50-year borrower, at the same point, still owes the majority of the original loan because the payment structure pushes principal reduction far into the future. This delay means that even after decades of paying, the homeowner's share of the property remains small while the lender captures most of the early value. Equity isn't just a number on a statement. It determines selling power, borrowing capacity, and financial mobility. When equity accumulates slowly, families cannot refinance, move easily, or leverage their home to stabilize emergencies. It compresses opportunity and increases vulnerability. Long-term loans also magnify risk during market downturns because low equity owners are more likely to fall underwater if prices decline, trapping them in a property they cannot sell or refinance. This degradation of wealth ties directly to the broader structure already established. The system uses extended terms to preserve liquidity for financial institutions, but in doing so, transfers long-term stability away from households. The 50-year mortgage doesn't simply extend payments, it extends dependency, turning what should be an appreciating asset into a slow-moving liability that delays or destroys the wealth Americans once relied on. The erosion of equity naturally raises the next question. If buyers lose so much, who gains from extending mortgages to half a century? The answer becomes unmistakable once you examine how the housing system is financially structured. The 50-year mortgage is not designed to protect households. It is engineered to preserve the profitability of the institutions that rely on housing debt as a long-term revenue stream. Home builders stand near the top of the beneficiaries. With construction costs rising more than 30% since 2020, the industry depends on maximizing demand to keep projects viable. Longer loan terms artificially expand the pool of qualified buyers, protecting revenues even when prices climb beyond wage growth. A buyer who barely qualifies for a $2,600 monthly payment becomes acceptable on paper, allowing builders to keep selling homes at elevated prices without adjusting to economic reality. Realtors and brokers are direct winners as well. Their commissions scale with home values, not loan terms. If the median home rises from $415,000 to even $450,000 due to increased borrowing capacity, commissions increase automatically. The 50-year mortgage functions as fuel for higher transaction prices, delivering larger payouts to the industry. The largest gains, however, flow to banks and institutional investors. Extending a $450,000 mortgage from 30 to 50 years transforms a $500,000 property into a payment stream exceeding $1.1 million. That extended timeline produces decades of interest income and expands the volume of mortgage-backed securities that Wall Street firms package and sell. A longer loan doesn't just increase profit, it stabilizes returns across generations of investors. Pension funds, insurance companies, and asset managers also benefit because long-term mortgage bonds offer predictable, multi-decade cash flows. As refinancing activity collapses and housing turnover slows, these institutions require new ways to sustain their portfolios. A 50-year loan solves that problem by lengthening the supply of debt available for securitization. This aligns precisely with the system described earlier. Housing has evolved into an investment architecture where stability depends on continuous debt participation. The 50-year proposal ensures the flow of payments remains uninterrupted, rewarding the institutions that rely on long-duration mortgages while transferring the cost to the households expected to carry that debt for most of their lives. Once you identify the beneficiaries of a 50-year mortgage, the consequences for the buyer become unavoidable. Every advantage granted to institutions is extracted directly from the household carrying the debt. And the structure of an ultra-long loan ensures the consumer absorbs the maximum cost. The mechanics built earlier, extended interest flows, delayed equity, and inflated home prices, converge into a single outcome: long-term financial dependence. For the borrower, the most immediate loss is time. A 50-year loan eliminates the possibility of paying off a home during peak earning years. Instead of achieving ownership by age 55 or 60, payoff dates drift into the late 70s. This means no mortgage-free years to redirect thousands of dollars monthly into savings, investments, or retirement. A household paying $2,600 a month for 5 decades forfeits more than $1.5 million in lifetime opportunity cost, even before accounting for inflation or lost investment returns. Principal reduction also becomes painfully slow. On a $450,000 mortgage, the borrower might still owe more than $400,000 after a decade because early payments are overwhelmingly interest. This makes it difficult to sell, refinance, or build financial security. Any economic downturn puts low-equity owners at heightened risk of becoming trapped, especially if prices fall while the balance remains high. The structure increases vulnerability rather than stability. Another disadvantage emerges through pricing pressure. As noted earlier, extending loan terms artificially expands borrowing capacity. When more people qualify for higher-priced homes, sellers respond by raising listing prices. The buyer ends up paying more for the same property, even though the monthly payment appears manageable. This creates a paradox. The borrower feels relieved month to month, but is burdened with a significantly larger long-term obligation. The extended term also guarantees exposure to more economic shocks. Over 5 decades, interest rate swings, job changes, recessions, medical bills, and housing market cycles are almost certain. A 30-year timeline might weather 1 or 2 downturns. A 50-year timeline captures all of them. The length of the obligation magnifies risk, not affordability. This chain of disadvantages is directly connected to the incentives described earlier. The structure works precisely because the buyer carries the burden while institutions secure predictable, long-duration income. Ultra-long loans don't fail by accident. They succeed by design, and their success depends on the consumer losing wealth, time, and financial flexibility. The structural risks surrounding ultra-long mortgages become undeniable when looking at countries that already experimented with them. 2 nations, Japan and Canada, provide the clearest evidence of how these policies reshape housing markets. And both outcomes connect directly to the same dangers now forming in the United States. Japan is the most extreme case. When its housing market overheated in the late 1980s, prices rose so rapidly that traditional loans were no longer viable. Banks responded by extending mortgages first to 50 years, then 70, and eventually 100 years. The expectation was that longer timelines would restore affordability. Instead, the extended terms amplified demand and accelerated price inflation. Homes in major cities reached valuations more than 10 times average household income, locking younger generations out of ownership entirely. These ultra-long mortgages did not stabilize the market. They prolonged the bubble until it collapsed, leaving families with properties worth far less than their remaining debt. Canada presents a more recent and equally alarming example. As home prices surged across major cities, lenders introduced 35-year and 40-year mortgages to make monthly payments appear manageable. Just like in Japan, the immediate effect was artificially increased purchasing power, which drove prices even higher. Home values rose so quickly that regulators were forced to intervene, eventually banning 40-year loans after realizing they were worsening the affordability crisis. Even today, despite shorter terms, Canadian households carry some of the highest mortgage debt levels relative to income in the world, a direct consequence of policies that stretched borrowing capacity instead of addressing supply and price fundamentals. These 2 countries demonstrate a universal pattern. Extending mortgage terms does not fix affordability. It inflates asset values, delays equity growth, and pushes households into deeper, longer-lasting debt. Japan shows how ultra-long mortgages can become generational burdens, while Canada proves that even modest term extensions destabilize markets. The consistency of these outcomes directly connects to the pressures now facing the U.S. market, revealing that long-term mortgages don't alleviate the crisis. They replicate the same problems seen abroad, only on a larger scale. The global warnings from Japan and Canada make one reality unavoidable. Long mortgages don't correct affordability because the crisis isn't rooted in loan structure. The real pressure point in the United States is a severe shortage of homes. Without enough supply, every financial solution, whether 30 years, 40 years, or 50 years, simply reshuffles how buyers compete for too few properties. Extending loan terms manipulates demand, but the underlying shortage keeps prices rising faster than incomes. America is short roughly 5.5 million housing units, a deficit created over more than a decade of underbuilding. This gap widened as population growth outpaced new construction, leaving entire metropolitan areas with demand far exceeding supply. The result is predictable: higher prices, longer bidding wars, and shrinking availability for first-time buyers. No mortgage design can offset the basic economics of scarcity. Zoning restrictions intensify the shortage. More than 70% of residential land in many major cities is reserved for single-family homes, blocking multifamily construction that could expand supply at lower cost. These rules limit density, slow permitting, and make it nearly impossible to build enough starter homes. The lack of buildable land keeps housing expensive, regardless of interest rates or loan length. Construction costs have also surged, rising over 30% since 2020 due to inflation, material shortages, and labor constraints. The industry faces a shortage of more than 350,000 skilled workers, making it difficult for builders to scale production. Higher input costs force developers to focus on larger, more profitable homes rather than affordable entry-level units. The market ends up with more luxury supply and not enough housing for average buyers. This structural imbalance ties directly back to the dangers posed by ultra-long loans. When supply is already insufficient, expanding borrowing capacity only inflates prices further. Instead of closing the affordability gap, extended loans widen it by driving demand into a market that cannot respond with adequate inventory. The real crisis is not the length of the mortgage, but the absence of homes to purchase. America's affordability collapse is not the result of a flawed loan. It is the consequence of a decade of insufficient construction, restrictive zoning, and inflated building costs. Until supply expands, any attempt to stretch mortgages simply reinforces the same cycle of scarcity and escalating prices. The supply shortage sets the stage for the next outcome. Extending mortgage terms doesn't stabilize the market. It amplifies volatility. When more buyers suddenly qualify for higher-priced homes, demand rises instantly while supply remains fixed. The result is upward pressure on prices, accelerating the same inflationary cycle that created the crisis. A 50-year loan doesn't lower the cost of housing. It enables sellers to push prices even further beyond wage growth. This artificial increase in purchasing power also inflates asset values, creating the conditions for a larger, more fragile housing bubble. When prices climb faster than incomes, households stretch themselves further, taking on debt levels that become unsustainable during economic downturns. With the median home already exceeding $415,000 and mortgage rates doubling within 2 years, adding half-century loans magnifies the risk of widespread instability. The extended timeline also increases exposure to recessions, job losses, and interest rate shocks. Over 5 decades, multiple economic cycles are guaranteed, making long-term borrowers more vulnerable to default during periods of financial stress. And because loan balances decline slowly, even modest price drops can push owners underwater, reducing mobility and increasing foreclosures. These market consequences align directly with the structural failures rooted in limited supply. Longer mortgages don't correct the imbalance, they inflate it, amplifying both the bubble and the long-term vulnerability embedded within the system. If 50-year mortgages become the norm, the structure of American life will shift in ways far more profound than the monthly payment suggests. Homeownership, once the core engine of middle-class stability, would transform into a lifetime financial obligation. Instead of paying off a home near retirement, most households would carry debt well into their 70s or 80s, leaving almost no mortgage-free years to accumulate savings or security. Prices would continue rising as extended terms inflate borrowing capacity. With supply still lagging by millions of units, homes would drift further beyond the reach of younger generations, widening the wealth divide between those who already own property and those entering the market. The average age of first-time buyers, already near 36, would climb toward the mid-40s, shrinking the window for equity growth. The financial system would benefit from stable, multi-decade revenue streams, but households would face reduced mobility, higher long-term risk, and diminished retirement prospects. A population trapped in mortgage debt cannot invest, cannot relocate easily for work, and cannot withstand economic shocks. If normalized, the 50-year mortgage would mark the end of traditional ownership and the rise of a permanent debt economy, a future where homes remain assets for institutions, but liabilities for the people living in them.